Good afternoon. Good afternoon. It's Monday, the 9th of June, and welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. And well, US-China relations seems to be toying a bit with a new fresh round of talks happening in London today. Is this going to be enough to get investors excited? Or are we continuing to see some confidence slipping in terms of US assets? Data there from the US is still a little bit soft, and the US dollar continues to weaken. So is the sell America trade still the main trading idea to go to? And if so, what are some of the alternative trading ideas out there? So that's something that we're going to focus today on our show. So the first question we want to answer is the primacy of the US dollar over? We've got some great insights from our macro team. Then we have our regional head of equity strategy, Anand Padmakanthan, joining us to share his bullish view on ASEAN and what some of his top picks are. We also take a look at CAPITALA, which is a parent company of AirAsia, and why we upgraded the stock to a buy. And finally, as always, we have some trading ideas from our chart guy. So without further ado, let's go get into the show. Now, there's a lot of discussions around the US dollar and whether its importance as the world's reserve currency is starting to weaken a bit. I highly recommend that you read the report by our macro team in today's newsletter called ASEAN Next Macro Report. This is a very comprehensive and also not very long article to go through, which actually gives a very good view on where the state of the US dollar is. In it concludes that the US dollar is starting to show some cracks, and for once, it's not just noise. It also has a compelling alternative argument. ASEAN currencies may be the next diversification frontier. Now, here's why. Even though de-dollarization itself has been slow, the US dollar is becoming riskier. And this is something that our own Maybank models have shown when you look at risk premium analysis. Safe havens like the yen and the gold, now they are rising in popularity, but they're also not very growth friendly. So that's where ASEAN markets really come in, and they offer a very unique mix. There's macro stability, there's an easing cycle, and relatively clean fiscal stories as well. So currencies like the Sing dollar, the ringgit, the IDR, and the Thai baht, now, they're not global reserve currencies for sure, but they do offer some diversification to investors as they can rotate out of some of their very heavy reliance on the US dollar. So I think this is a trade that's going to get too big to ignore as we progress through the year. Now, in terms of adopting ASEAN currencies for trade is still very limited. But the interest is growing. I mean, if you look at Singapore and the Singapore dollar, it's already showing signs of gaining some ground as a quasi-safe haven currency in the region. And all of this means that ASEAN, even with all its imperfections, is quietly positioning itself to be a credible and diversified alternative. So I do really recommend you read the note in today's newsletter on this. Now, let's stay on the topic of ASEAN and let's focus on stocks. So let's bring Anand Padmakanthan, our head of regional strategy, on the line. Anand, welcome to the show. Now, ASEAN has been through a lot in the past 2 to 3 months. We had surprisingly high reciprocal tariffs being slapped on quite a few countries by the Trump administration during Liberation Day. And we saw a lot of markets see some steep declines. Since then, we've also seen some pretty strong rebounds as well. Now, before we go to the individual countries, Anand, can you give us an overview of how you are thinking about the region, especially relative to some of the other global markets?
Yeah, hi, Thilan. Thanks for having me on. Yeah, I think we on April 2nd, when Liberation Day was announced, we obviously became quite negative and we turned very defensive. But in the weeks subsequent to that, bullishness has recovered. I think most investors looking at ASEAN sort of realize that there's a lot of room from tariff negotiations for the rates to come down. And this is especially the case after the US-China de-escalation on May 12th. Some countries like Vietnam, where the tariff rate is 46%, it doesn't make sense for it to remain at that level when China is going with 30%. So we do see downsides. So I think, risk appetite has improved. And there's been a huge tailwind. Initially, when tariffs were imposed, we thought the US dollar would strengthen. But actually, it started to weaken because of all the policy volatility in the US. People are losing faith in US dollar assets. And that's causing a US dollar to decline as well. And that's great for emerging markets like ASEAN. So you have this tailwind of strengthening regional currencies, improving macro stability, and that's opening the door to interest rate cuts. So overall, the macro situation has improved quite significantly in the last couple of weeks for ASEAN.
Got it. Now, I find it very interesting that from a country standpoint, you've got Singapore, Malaysia, and Indonesia as your overweight countries in ASEAN. Now, I kind of want to go country by country here. So let's start with Singapore. What's actually driving your optimism here? And also, what are some of the stocks investors should be playing?
Yeah, as you just mentioned, I think Singapore is recognized as a safe haven, especially from a currency and fiscal perspective. The currency has always been viewed as a defensive sort of play. And Singapore, of all the ASEAN countries, has the most room for fiscal stimulus if required to keep GDP growth on track. So I think that's well recognized by investors. But there are a couple of other things happening at the market level as well. You have the China recovery or reflation story. And unlike all the other ASEAN countries, yes, China reflation is good at a macro level, but for the Singapore market, it's directly positive for earnings as well, given that 2/3 of your top 50 stocks have material China exposure. So that's something that investors are starting to realize as well. As China reflates, perhaps the biggest earnings upside in ASEAN from a market perspective is Singapore. And then you have the capital returns thematic, which is still intact. So you're still seeing a lot of share buybacks, higher dividends from big cap government-linked companies in Singapore, including the banks as well as stocks like ST. So that's improving the ROE profile for Singapore stocks as well.
Got it. And any favorite stocks you want to highlight?
Yeah, I think one big play we're talking a lot to clients about for the second half is REITs. Yeah, because we've already seen the SORA coming off quite significantly in the first half of this year. Despite the Fed being mostly on hold. Now, as the Fed resumes cutting in the second half of the year, as we expect 2 more cuts. We expect the Singapore interest rates to also come off quite sharply. So the REIT sector, which has been sort of lagging a little bit, we think will really catch fire in the second half of this year as interest rates continue to come off. So we're talking about stocks like CLAR, CICT, FCT being on our buy list.
Got it. Actually, there's a question from Jeffrey Chan on alternative investment in T-bills 6 months. Is that good? I mean, Jeff, I'm assuming you're talking about Singapore 6-month T-bill, which is seeing yields coming off. So I think that kind of plays very well with what Anand is saying on the REIT side. I think as an alternative asset class that hasn't performed well, the spread continues to increase versus the T-bill rates and policy rates for the REIT. So I think that's a sector that you should probably be looking at. Now, Anand, coming back to you, the KLCI has been treading water for most of this year, and the latest first quarter results season has been classified as a little bit underwhelming. So why is this market an overweight, and what are some of the key stocks that we should be watching out for?
Yeah, I think the big, sort of headwind for Malaysia at this point in time is the unknown of semiconductor and electronics tariffs by the US. Of all the countries in ASEAN, Malaysia, probably the one that's most affected by potential tariffs on semicon and electronics exports to the US. So until that overhang is cleared up, it is quite difficult for the Malaysian market to move forward. And yes, the first quarter earnings were relatively soft. We had earnings for the market down both year-on-year and quarter-on-quarter. But I must stress that this is after a very strong run in 2024, where we had 4 very good quarters. So perhaps, some pullback is not really unexpected in terms of expectations. Having said all that, we have been on an upgrade sort of spree in Malaysia for big caps. We've upgraded Tenaga to buy. We've upgraded Capital A, the regional low-cost airline. to buy as well, along with some other like consumer stocks like Mr. DIY. So we do see value in the market. We do expect the market to perform once the uncertainty around the semiconductor sector tariffs are resolved in the coming weeks or months. So, it's definitely something that investors should keep in mind. The market is lagging now, but the second half should see a better performance.
Got it. Got it. And Indonesia, I mean, that's actually been a pretty strong performer for the last 3 months or so, up about 11% on US dollar terms. So what should we be looking out for in this market? And again, what are some of your favorite stocks here?
Yeah, I think Indonesia has been the biggest beneficiary among all the ASEAN countries of this switch out of US dollar assets. Weakening US dollar, strengthening rupiah has really restored a semblance of macro stability to Indonesia and, of course, the Indonesian market as well. And that has really helped the market rally over the last couple of weeks. I think the big thing we're looking forward to in the second half are significant interest rate cuts now that inflation is under control and the rupiah is stabilized. And that's really going to help the interest rate sensitive sectors like banks, property, and some infrastructure plays as well. So right now, the market looks a little bit full. We'll be taking some money off the table, perhaps switching to defensives. But longer term, we would go with the banks, things like BBCA or Bank Sharia, also property like Ciputra or Pakuwon, and maybe one or two cement companies to play the broad infrastructure potential upside.
Got it. Now, I actually find quite interesting that you've classified Philippines as neutral. I mean, yet this has actually been one of the best performing markets this year from a regional point of view, especially in the past 3 months. What do you need to see to get you more excited about the Philippines, and also any key stocks that we should be watching out for?
Yeah, I think we've maintained it neutral for quite a while, primarily because we were going into midterm elections in the Philippines in May. And, given the quite fractious politics in the Philippines between the president and the vice president, we wanted to see that resolved and come to a sort of a landing before we revisited our call in the Philippines. But you're right, things do look good for the Philippines. Obviously, the peso is strengthening, and that's helping reduce the inflationary pressures. The Philippines is a big importer of food and energy, so a stronger peso plus lower energy and food prices, all combining to bring inflation under expectations. And that's good because it opens the door to more interest rate cuts and it also boosts consumption power. So if we wanted to be in the Philippines, definitely you'd be looking at the consumer stocks like SM, like Jollibee, and also some of the banks which are seeing very good credit growth recovery, like BDO and Bank of Philippine Islands as well, BPI.
Got it. Got it. Now, you've got Thailand and Vietnam both in the same bucket as neutrals. What are some of the headwinds that you're seeing for these markets? And also, what are some of the tailwinds here? And any stocks you like?
All right, so Thailand remains the toughest case. I think it's the worst performing market in ASEAN year to date, still down double digits. We are still seeing GDP downgrades coming through. So GDP forecast now for Thailand mostly below 3%, which is quite weak. And also, we're seeing politics remaining an issue. I think there's a court case resolution, at least this month, relating to Thaksin and potentially a cabinet reshuffle as well. So all those uncertainties, the weak macro environment, weak tourism, all feeding into a relatively bearish environment in Thailand. So we will definitely be defensive there. We were very selective in Thailand. We like sort of small mid-cap stocks, which are benefiting from fiscal stimulus, like Tasco or CK in the construction place, and also one or two which are exposed to more government contracts for, say, software like Sky, and also Thai life insurance as well for interest rates coming off. So yeah, Thailand, tough one. I think we will remain neutral for quite a while. Vietnam, just to finish off, is the dark horse, and it's rebounded very strongly in the last few weeks. As I mentioned before, the US-China de-escalation, it really makes a whole lot of sense for Vietnam's tariffs to come down below 30% from the headline 46%. So the markets are factoring that in. The markets are also looking forward to the upgrade of the market to emerging market status from Frontier currently by FTSE in September 2025, which we expect to happen. But third, and perhaps less appreciated at this point in time because of tariffs, is the fact that the government itself is pushing through a lot of domestic reforms to empower the private sector in Vietnam. Now, we're reporting on that more and more in the last couple of days. I think we have a research piece out on that as well. But frankly, if Vietnam is able to make that switch from trade or government-driven growth to the private sector, that economy structurally could do 7-8% GDP growth for the next 5 to 10 years. Yeah, so that's very exciting. So I think Vietnam, is looking quite good right now.
Got it. And Anand, very quickly, I know you've been on the road meeting a lot of North Asian investors over the past week or so. Any key takeaways there?
Yeah, I mean, North Asian investors have always kept an eye on ASEAN in terms of familiarity. They've been investors here for a long, long time, and they do appreciate the fact that ASEAN is in a bit of a sweet spot in terms of China plus one, relocations, also in terms of reduced demand for US dollar assets, potentially shunting capital flows into ASEAN as well. However, they still struggle with finding the liquidity to invest in the region. And also, like China plus one, they recognize it's a positive for the economy, but like all of us investors, it's frustrating because we don't see it crystallizing into upside for the equity markets. So for them, yes, they are watching. They're interested to perhaps nibble at some of the stocks in ASEAN, but they're very much focused on the big caps, over 20 million US dollars a day market liquidity. And that's really mostly the banks and one or two big consumer or utility players in the region at the moment. Yeah.
Got it. Anand, thank you very much for that comprehensive views. Do have a look at his note in our newsletter today. Now let's turn our spotlight to Capital A, the parent company of AirAsia, which Samuel Yin has just upgraded to a buy. He highlights 6 key reasons behind his upgrade. First is return to profitability. They just posted its first core net profit since the pandemic. That's a huge turnaround. Passenger traffic is up, fares are strong, and cost efficiencies are kicking in. So it's a sign that the post-COVID travel rebound is continuing to be real for them. Second, the outlook is robust. The airline operations are flying high. Load factors are back to 87%. Fuel prices are stable. So we expect pretty strong earnings momentum to come through. And certainly for FY26 next year, we are looking at earnings expanding around 41% year on year. Third, there's restructuring in motion. The group is in the final stages of restructuring. They're spinning off their airline business into a new entity that's going to be listed on Bursa Malaysia. This will simplify their overall structure and unlock value. Plus, they're targeting coming out of their PN17 financially distressed classification by September, and that'll remove a big overhang from the stock as well. Fourth, there's some global listings coming as well. Capital A isn't just looking at listing on Bursa, they're looking at doing a dual listing on Hong Kong Exchange, and they're listing brand AA, which contributes nearly half of their non-aviation EBITDA on the NASDAQ. So all of these can potentially open up more value unlocking for AirAsia. Fifth is that digital and logistics businesses. It's not just about planes. Capital A's Move digital arm and teleport logistics units are gaining traction. The market has not been paying too much attention to these businesses. But so these assets might also, as these assets get listed, these can actually be a pretty serious value driver as well. And finally, valuations are still very attractive. It's still trading at a very steep discount. So I think given the very clear path to value unlocking and also coming out of their financially distressed status, I think this is a stock that you need to have a look at now. There's a great report by Samuel in our newsletter today. Now, before I finish off, there's a question from AI Tan who's asking, what should we expect from the Trump and co talks, and do you see a lot of downside risk? Well, I mean, after the call on June 5th, there seems to be some resolution on the rare earth exports, and he's also accepted an invitation to visit China. Beijing has said they've been complying with a lot of the terms on the trade truce as well. So that is good for investor confidence. They're starting talks in London today. So much will be riding on this for China and the US investors. The markets will be watching if tariff rates can be brought down meaningfully to enable trade and also to keep inflation in check, especially in the US. Right now, if reciprocal tariffs are fully implemented and the trade after the trade truce period expires, essentially it's still a trade embargo. So that's one of the big downside risks to watch out for both countries. I think investors will also be looking for concessions around export controls around AI chips, as well as the visa revocations for Chinese students as well in the US. So there's still a lot of unknowns, and I think those are some of the key downside risks to watch out for, and optimism is fragile. And also, one of the other downside risks is Trump might actually turn his attention to a different country. And while these negotiations with China are going on, and that will add a new frontier to all this trade tariff uncertainty. So I think, if you kind of go with the conclusions today, I think the Sell America trading strategy continues to remain for us. Now, with that, let's turn to our chart guy. We've got two trading ideas. One is Nanofilm. It's recently staged a bullish reversal breakout, and the upside momentum there could continue. And secondly is Thakral Corporation, which he has a trading sell on. It's actually enjoyed a very strong bullish run. Now it's in extremely overbought territory. So very classic signals for potential profit taking. In terms of macro events to watch out for, we're looking for the unemployment rate on the 9th of June, which is today. We're also looking at the Nodex numbers coming out on the 18th of June, and also industrial production numbers on the 26th of June. These are some of the key things that we'll be watching out for. With that, we are unfortunately out of time. Thank you so much for joining us. Thank you for your support. Have a profitable trading week, and we'll see you next week.